All right, good evening, everyone.
Good evening, sir.
So you're welcome to our SFM class once again. Without wasting time, let's go to where we stopped in our last class. I think, I think I've solved that. Let me go to where investment appraiser. And I think we've solved 3 questions so far, right? So let me go straight. Scroll down. Okay. So in our last class, we have completed the questions on mathematics of finance, and we've started the procedure for computing our net present value as a method of one of the non-discounting techniques. Sorry, one of the discounting techniques of investment appraisal. Specifically, we have looked at how taxation affects our NPV calculations and how you are to deal with tax. Then we also look at balancing capital allowance and how it should be treated while computing NPV. We also look at interest, where we said that interest is what? Though it's a liable, it involves movement of cash, it's a cash flow item, but it is not relevant in the computation of NPV simply because it is part of the items that we use in the computation of our cost of capital, which is our work. So today we continue from there, and we are going to start by looking at discounting cash flow and inflation. Discounting cash flow and what? And inflation. That is, we want to look at how inflation affects our cash flow and how you should approach a question where you have inflation rates. So we look at method of treating inflation. Now, inflation has the effect of increasing price level. Okay, it has the effect of increasing the price of items. So for cash flow, when you estimate a cash flow for this year, for instance, that cash flow may have been affected by inflation rate in the next period. So if I say my cash flow is 5,000 naira every year, for instance, that 5,000 naira next year, apart from discount, it must have been affected by what? Inflation rate. Because of that, you need to ensure that you factor in the effect of inflation whenever you are estimating your cash flow. We need to factor in the effect of inflation. Now, how do we factor in the effect of inflation? You have to know that we have 2 types of inflation. The first type of inflation is what we call specific inflation. Okay, we have what we call specific inflation. And when we say an inflation rate is specific, what we are simply saying is that each of the items of the cash flow in that question is affected by a unique inflation rate. For instance, you have your revenue, you have your variable cost, you have your fixed cost. Where you see that revenue has its own inflation rate, variable cost has its own inflation rate, this inflation rate will be regarded as specific inflation rate. So each specific item in what? Item in the question is having its own inflation rate. That will be regarded as a specific inflation rate. Now, where you have specific inflation rate in the question, you need to apply that inflation rate on the cash flow that is affected by that rate. Okay, Now, as you have inflation rates, we can also have inflation rate of cost of capital, which is your WACC, okay? However, your cost of capital is not affected by a specific inflation rate. Cost of capital is affected by a general inflation rate, okay? So apart from specific inflation rate, which affects individual item in the cash flow, the general inflation rate will affect everything at the same time. So when we say inflation is general, we are simply saying that that inflation rate will affect your revenue, it will affect your variable costs, it will affect all other costs, including your cost of capital. So where you have all these variables being affected by just one inflation rate, we say that inflation rate is a general inflation rate. Okay, we say it's a general inflation rate. Now, let me put you straight to our working paper. When you are carrying out a discounting technique, the principle is this. You will have what you call, let me put it as a treatment of inflation rate. Let me put it that way. Treatment of inflation. Treatment of inflation. Okay. So we have what you call one, types of cash flow. Types of cash flow. Types of cash flow. Okay. Types of cash flow. Cost of capital needed for discounting. Cost of capital needed for discounting. Now, the first type of cash flow you can have, we call it real cash flow. Okay, we have what we call the real cash flow. And what do we mean when we say a cash flow is real? When a cash flow is real, it simply means that that cash flow has not been inflated. Okay, the cash flow has not what? Has not been inflated. So when you have a cash flow that you have not considered the impact of inflation on that cash flow, we say the cash flow is a real cash flow. And when you want to discount a real cash flow, you need real cost of capital. We need real cost of capital by principle. Anytime you look at your cash flow and you see that that cash flow is what? You see that that cash flow is a real cash flow, then you need to discount that cash flow using a real cost of capital. Okay, you use a real cost of capital. Now you can also have what we call money, or we call it nominal, or we call it nominal what? Cash flow. We call it nominal cash flow. So when you have a nominal cash flow, nominal cash flow should be discounted using money or nominal cost of capital. Nominal cost of capital. That is a principle. That is a principle. So you see that what am I doing here? I'm discounting real cash flow using real cost of capital. I'm discounting money or nominal cash flow using money or nominal cost of capital. So when we say money cash flow or nominal cash flow, we are saying that that cash flow has already been inflated. We have considered the impact of inflation on that cash flow. And that is why we regard this as what? As a nominal or money cash flow. And when you want to discount that money cash flow, you need to discount it using a money cost of capital. You discount it using the money cost of capital. That is the principle. Now, real cash flow can be called by several other names apart from real. For instance, the real cash flow can be called real cash flows can be referred to as one, cash flow in real term, okay, in real term, or the question can tell you it's cash flow in terms of year zero prices. That's number 2. Okay, number 2, you can call it cash flow in year zero prices. In year zero prices. So whenever you see this, what the question is simply telling you is that cash flow is real. So we are going to come across several of these, and I will let you know how it should be interpreted. Now, sometimes you will be given a real cash flow. Okay, you will be given a real cash flow. Instead of the question to give you a real cost of capital, so see, this is what I'm saying. The question will give you this. Okay, the question will give you this. But instead of the question to give you the corresponding cost of capital that you need, the question will now come and give you what? The question will come and give you nominal cost of capital. Nominal cost of capital. When you have this situation, there is a problem, because the principle is discount real cost of capital, discount real cash flow using real cost of capital. But now, the question has given you real cash flow and money cost of capital. So it will be inappropriate for you to pick that money cost of capital and use it to discount the real cash flow. It will not be appropriate. So what do you need to do? You can do one of two things. One is either you convert this real cash flow to what? To nominal cash flow. Look at it. It's either you convert it to nominal cash flow. By the time you convert it to nominal cash flow, it will not be in the same level with what? With money cost of capital. Or you may decide to convert your what? Your cost of capital to what? From money to real. Can you see that? Can convert from money to real. So that you now be having real cash flow and real cost of capital. But at all times, the two of them must be in the same on the same level before you can carry out your discounting. Okay, let me check. Hope I've not forgot to record this. Okay, record is enabled. Okay, so that is the principle. Discount real cash flow using real cost of capital, discount money cost of capital, discount money cash flow using money cost of capital. Now, the question you will now ask me, when I say, it's either you convert real cash flow to money cash flow or convert money cost of capital to real cost of capital. You now ask me, how do we do this? I mean, how do we convert? Let's go back to our note. Let us go back to our note. For you to convert from real to nominal or vice versa, you are going to use what you call, okay, first of all, for cash flow, let me be specific to you now. For cash flow, if you want to compute cash flow, you know, I told you that the inflation rate that affects cash flow and cost of capital is what? Is general. Cost of capital does not have specific inflation rate. Please take note. Cost of capital does not have what? It does not have specific inflation rate. It is only cash flow that we have specific inflation rate. So the only inflation rate that will affect both cost of capital and cash flow is general inflation rate. So where you have a question, and in the question you look at the question, you see that the question has only given you general inflation rate. Now, it's either you use the general inflation rate to what? To convert your cash flow from real to nominal, or you use the general inflation rate to convert your cost of capital from nominal to what? To real. Do you understand this now? Now, if you want to convert, you just apply the what? If you want to convert the cash flow, just grow the what? Grow the cash flow in the number of years. You see the general inflation rate. That is simple. That's how to convert. But if you want to convert cost of capital, you cannot convert cost of capital in that manner. If you want to convert your cost of capital, you have to use an equation that we call Fischer's equation. This is the Fischer's equation. Fischer's equation tells us that 1 plus money cost of capital, which is our money rate here, is equal to 1 plus real cost of capital, which is our real rate, times 1 plus inflation rate. The inflation rate here, let me state it again. The inflation rate here is not specific, it's general inflation rate. So 1 plus money cost of capital is equal to 1 plus real cost of capital times 1 plus inflation rate. That is the Fischer's equation, okay? That is the Fischer's equation. Now, how do we apply this? How do we apply this? Let me go back to our working paper. How do we apply this? Now, I'll give you as what? 1 plus M is equal to 1 plus I, 1 plus R, 1 plus I. This, the formula I gave you, right? Now, if I want to convert money cost of capital, I want to convert it to real cost of capital, what do? I will simply make R the subject of the formula. I will simply make R the subject of the formula. When you make R the subject of the formula here, you have your R, okay? You have your R is equal to 1 plus M, 1 plus M, all over 1 plus inflation rate minus 1. This is what you're going to have if you make out the subject of that formula. What about if I'm given real cost of capital, I need money cost of capital, also make money cost of capital the subject of the formula. Okay, so money cost of capital, will simply be what? Will be equal to 1 plus R, 1 plus R into bracket 1 plus I, everything minus 1. This is how you get your money cost of capital. So this is what we call Fischer's equation. Let's, for example, e.g., let us assume that money cost of capital is 8%, and general inflation rate is equal to, let me say, 3%. And the question asks you now, you want to convert this money cost of capital now. This money cost of capital, you want to convert it to what? To real cost of capital. I will simply say that my real cost of capital is equal to 1 plus money, that is 1 plus 0.03, close bracket, all over 1 plus 0.08, sorry. 1 plus 0.03, close bracket, everything minus 1. Okay, everything minus 1. That will give me what? Let's use our calculator. That should give me what? Let me bring out my calculator here. 1 minute, please. Use your calculator also to get the figure. We have 1.08 all over 1.03 minus 1 times 100. You have approximately 4.85%. 4.85%. That is the real. Mrs. What's her name? Mrs. Shiwe is no longer on this call. Can someone call her, please? Let's hold on. Mrs. Angela has left also. What's wrong? See that network? 1 minute, Mrs. Shiwe. Let me. Let me put a call across to them.
Okay, sir.
Okay. So our real cost of capital will be what? Will be 4.85%. Now, let us go back and compute our nominal. You know, our nominal is 8. We computed that 8, and sorry, we're given that 8. We used to compute our real cost of capital, which is 4.85. Now, let us use this real to go back to our nominal and see how you do that. I will say my money cost of capital is equal to 1 plus real. Real is 0.0485 close bracket times 1 plus 0.03, everything minus 1. Okay, so our money will be equal to 1.0485, 1.03, all minus 1. So let's see, what will this give us? We have 1.04485 times 1.03 minus 1. What do we have? Times 100, 7.995%. So that will give us what? 7.9955%, which is what? Which is 8%. Which is 8%. This is how to convert from money to what? To real, and from real to nominal. Now, let me now tell you this. We are the only one remaining.
Yes.
What do we do?
Let's call them. I don't know. Maybe it's your network.
Let me stop the recording first. Let us continue. Mrs. Angela has joined. Let us continue. I've called Mrs. Chinwe. She said she's trying to join, that we should continue. So this is how we compute, or we convert from real to nominal, and from nominal to real cost of capital. Now, let me tell you this. When you have a question, and you see that in the question you have general inflation rate, don't bother to grow your cost of capital, because growing your cost of capital individually will take your time. Okay, it will take much time. Just leave your cash flow that way, then go and convert your what? Go and convert your cost of capital. It's much more easier to convert your cost of capital than for you to grow all your cash flow. So we shall see this when we solve comprehensive questions on the net present value. Okay. So let's take, sorry, please, this question 4. We are going to paint the question 4. The reason why we are painting it is because that question is a question on risk and uncertainty in investment appraisal. So I want to take that question after we have taken risk and uncertainty. So we are going to hold that question for now, that question 4, until we get to risk and uncertainty. So because of this, let's go to question 5. Let us go to question 5. Okay, question 5. Now, the usual approach that you should adopt in solving SFM question is that, especially question number 1, is that you should try and read the requirement of the question first, because the question is going to be large. So read the requirement of the question first before you read the question itself. Reading the requirement of the question will give you an insight as to the variables you should be looking out for in that question. So it gives you focus, it gives you insight, okay? But if you go and read the question first before you read the requirement, it means after reading the requirement, you have to go back and read the question again. And if care is not taken, each time you want to pick an information from that question, you need to go back and read the question again. And that will waste a lot of time. So what you should do is that you look at the requirement of the question, get your insight, because knowing your requirement will have given you an insight as to the principle that applies. So go and read the question and jot down those items you can pick in each of the paragraphs of the question, so that when you want to start solving that question, you will not need to go and reread the question again. You will only read the question once, or at most twice, in order to get all the information that you need. But if you go and read it, each time you want to pick an information, you go and read it again. You want to pick tax rate, you go and read it again, then you will have succeeded in wasting your time, okay? So let's go and see the requirement of this question. What does the question want us to do? So let's see. What does the question want us to do? I think.
How many pages is this question? So long.
No. It's not many pages. Just I'm coming. Okay. I think I've scrolled past the question. Yeah. This it. Okay, this is the requirement here. This is the requirement of the question. Required. A, given the information on MEPSC and the project financing mix, including any other relevant information, calculate the project specific cost of capital. Calculate the project specific cost of capital. And B, assess whether KPSC should undertake the project of developing and commercializing the major component of outboard engine, assuming a discount rate of 12% has been applicable for the assessment, irrespective of your calculations in A above. C, state any three relevant assumptions made for your calculations in A and B above. So this is ICANN adapted question. It's an ICANN adapted question. So let's now go. You can see that this has given you an insight. You know that in A, you are going to compute project-specific cost of capital. And you already know the principle. That if you want to compute project-specific cost of capital, most likely you should have what? You should have a proxy company. You should obtain the proxy better. You should ungear. You should regear. Then put it in work, compute your cost of debt. Then what? Sorry, put it in CAPM, compute your cost of debt, then go and what? Go and work it. Isn't it? So that has given you insight because you already know the procedure for computing project-specific cost of capital. And B is that you should assess the worldwideness of the project. Now, the question did not ask you to use NPV or APV. However, we're using NPV. When we get to where to use APV, that shall be explained in detail so that you now know the difference between NPV and APV. So let's see the question now. Let's see the question. Okay, KPLC, a listed company based in Warri, Delta State, has been involved in producing boats, but excluding the engines. The company is now considering diversifying. Can you see that? That's the reason why the question says compute project-specific cost of capital. You can see the information there. You can see the information. The company is diversifying. Okay, the company is diversifying, and don't forget that I have already told you that anytime a company is diversifying, a company is going into another industry. That's what it means. to undertake a project, then project-specific cost of capital need to be computed for that particular project, except where the question tells you that the risk of the new industry is not significantly different from the current industry of the company. That is the only way you can use the current work of the company. Let me repeat it. If a company is going into another industry to undertake an investment, now the company will need to compute a project-specific work for the diversified project. However, if the question tells you that the current industry that the question is, and the industry the question wants to go into, their risk is similar, not the same, but not significantly different. So if the risk of the two industries are not significantly different, then you can use your current work, because it means the current work of your current industry is still going to be almost the same thing as the project-specific work you are going to compute. So there will not be need for you to bother yourself in that instance. Except this, in all other cases, you will need to compute a project-specific work, okay? So let us continue. The company is now considering diversifying into the production of a major component of outboard engine. For this purpose, the company has recently purchased the patent right for 15 million to produce the component. That is paragraph 1. In paragraph 1, the information I can pick here is that the company is diversifying. And the second question is that the company has purchased a patent right for 15 million naira for this project. Now, how do I classify the patent right? Is it a relevant cash flow or an irrelevant cash flow? Look at it very well. Do I classify it as a relevant or as an irrelevant cash flow? Which one? I wait your opinion on this, because you must be able to classify each of the cash flows in the question before you can successfully carry out project evaluation using the discounting technique. So how do I classify the patent rights of 15 million naira in this question? Are we there? Is it relevant or irrelevant? If it is relevant, why? If it is not relevant, why?
It's relevant.
Okay, why?
Because it's just recently purchased. Intangible.
So it is relevant. Okay, Mrs. Angela, what's your opinion on this? This is why I'm asking is that I want to ensure that you understand what we are doing here. Very important. Mrs. Angela, your opinion?
I'm not sure.
Okay. That's why I say your opinion.
I can't say opinion where I'm not sure. I'm not sure whether it's relevant or relevant.
Okay, thank you. Now look at it. The principle you should adopt when we are carrying out discounting technique is that the cash flow you are using, okay, the cash flow you are using should be future cash flow. What I say? The cash flow you are using should be future what? Cash flow. It should be future cash flow. Now, looking at this now, is this a future cash flow? Is this a future cash flow?
No.
No. This is not a future cash flow. This is a what? This is an historical cash flow, Abi, because that patent has already been purchased. Now, it's like, for instance, you want to, or let me say, okay, let me say you. Let me say someone want to do a wedding. Okay, you want to do a wedding, and the person has purchased the wedding gown, but unfortunately, that wedding could not hold. What happened to the wedding gown? Will you go and return it after several months of purchase to the seller? No. So the moment you buy that wedding gown, whether the wedding holds or not, you can no longer recover that money, isn't it? The same principle applies here. We are evaluating this project, but already we have bought the patent right that will enable us to carry out this project. Now, if we evaluate whether that project is profitable or not, and we now discover that the project is not profitable, it means we not manufacture again, Abby. So do we now go back to government and say, please, we want to return your patent, you should pay us back our money? No. So that cash flow, the decision of whether to do the project or not, is not affected by this cash flow again, because that cost has already been incurred. So any cost that has been incurred in the past is not relevant for decision making. So that will be regarded as a sunk cost. It will be regarded as a sunk cost. I believe that is clear. That is a principle you should always apply. KPSC has spent 20 million developing prototypes of the component and undertaking market studies. The research studies came to the conclusion that the component will have a significant commercial potential for a period of 5 years, after which newer component will come into the market and the sales revenue from the component will virtually fall to zero. The research studies have also found that in the first 2 years, that is the development phase, there will be considerable training and development costs, and fewer components will be produced and sold. However, sales revenue is expected to grow rapidly in the following 3 years, which is the commercial phase. Now look at this. How do we classify this research? This is research and development called market studies, okay? Now, this 20 million that has been spent, how do we classify it? Relevant or irrelevant? Mrs. Angela, you should answer this. Relevant or irrelevant?
Which one is that?
This 20 million here, is it relevant or irrelevant?
Irrelevant.
It's what? I didn't hear you.
Irrelevant.
Irrelevant, Abby?
Yes.
Yeah. Why is it irrelevant?
It's been spent.
Exactly. Because it has already been spent. Can you see that? That's the principle. Perfect. That's perfect. Because that money has already been spent from the language. The money has been spent in the past, so it is no longer relevant. So for the purpose of clarity, when you discover an irrelevant cash flow in your question, please just cross it out so that you know that you are no longer going to consider that cash flow. So just cross it out. It's better that way. So, and we're told that the project will go for 5 years. Consider that the project will go for 5 years. 5 years. And there's going to be training and development for the first 2 years. Abby? For the first 2 years. That is paragraph 2. Now, paragraph 3. It is estimated that in the first year, the selling price will be 2,000. You can see the language here will be, that is a future. That is a future cash flow, will be future tense. It will be, it's different from it has been, okay? So the selling price will be 2,000 naira per component. The variable cost will be 800 naira per component. And the total direct fixed cost, please take care of this name. Direct fixed cost. Normally fixed, am I recording this? Okay, the recording is enabled. I thought I'm not recording it. It's being recorded. So the fixed cost here is a relevant fixed cost because the client tell you is what is a direct fixed cost. That cost is coming as a result of the project. That is the reason why it is relevant. But had it been that fixed cost is an existing fixed cost, I want to allocate it to that project, it will not have been relevant, because when you have an existing fixed cost and you want to allocate part of it to the new project, no, because whether you do that project or not, the existing fixed cost will still be what? Will still be incurred. But this one, the question has told this one is a direct fixed cost. So this is very simple to identify. Okay. Thereafter, while the selling price is expected to increase by 8% per year, the variable and fixed costs are expected to increase by 5% per year for the next 4 years. Training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. That's the training and development costs. Okay. The estimated average number of outboard engine components produced and sold per year is given below. We have year 1 to year 5, 15,000, 40,000, 100,000, 120,000, 190,000. Machinery costing 480 million naira will need to be installed prior to the commencement of the component production. KPLC has enough space in each factory to manufacture the component and therefore will incur no additional rental cost. Tax allowable depreciation is available on the machinery at 10% on straight line basis. The machinery is expected to be sold for 160 million naira at the end of year 5. The company makes sufficient profit from each other activities to take advantage of any tax loss relief available from this project. Initially, KPLC will require additional working capital for the project of 20% of the first year's sales revenue. Thereafter, every 1 naira increase in sales revenue will require a 10% increase in working capital. Although this will be a major undertaking for the company, it is confident that it can raise the finance required for the machinery and the first year working capital. The financing will be through a mixture of a rights issue and a bank loan in the same proportion as the market value of current equity and debt capital. Any annual increase in working capital after the first year will be financed by internally generated funds. Now, Marine Engineers PLC is a listed company involved in the manufacture of outboard engine components for many years. That is our proxy company. ME is our proxy company. Additional information, extra from statement of financial position. We have KPLC, we have MEPLC. Non-current assets, working capital, 6% bank loan, 5% loan note, share capital of 50 kobo each. We also have share capital of 1 naira each. Reserves, current market value per share, quoted better. The loan note of MEPLC are quoted at 102 per 100. Other data. Tax rate applicable to KPLC and MEPLC is what? 20%. It can be assumed that tax is payable in the same year as the profit on which it is charged. So tax is paid irrelevant. You can see the information I told you. The examiner will let you know. But in the case that you are not to make your assumption and move ahead. So it can be assumed that tax is payable in the same year as the profit on which it is charged. Estimated risk-free rate of return, 3%. Historic equity market risk premium is 6%. So compute the project specific cost of capital. So let's go and solve that. Question 5. Example 5, KPLC. You can make a computation of project specific computation of project specific work. So what is the procedure? Procedure one is what? Identify your proxy company. Don't forget, we have done this. Your proxy company. So what's our proxy company? Our proxy company is Marine Engineer. Marine Engineer. That is ME. PLC. PLC. That's our proxy company. That's our proxy company. So we obtain the proxy beta. So proxy equity beta. So let me just put it as BE. Proxy equity beta is given as what? What is the proxy equity beta? Marine Engineer. Okay, look at the beta here. Look at this beta. The question did not tell you whether it is equity beta or asset beta. How will I know? Now, this beta here, we said Marine Engineer is our proxy, Abi. So Marine Engineer is our proxy. Which one is for Marine? The second one here. So look at the beta. I don't know whether that 1.8 is equity beta or asset beta. How will I know? I will go and look at the information of MEPSC. MEPSC, are you having that? MEPSC says yes. I'm having 5% low notes. So I am geared. If I am geared, then my proxy beta is what? Is equity beta. My beta is equity beta. That's how I will know that this is equity beta or this is asset beta if it is not implicitly stated in the question. I just have to judge by the information of that company that is having that beta. So I can say here that my beta is 1.8 and it is what? It is an equity beta. So if this is an equity beta measures the risk of the industry and the what? And the financial risk of MEPSC. And I told you earlier that two companies cannot have the same financial risk. Two companies can have the same business risk if they are in the same industry. But even when they are in the same industry, they cannot have the same financial risk because their borrowing will differ. Their borrowing will differ. Therefore, I need to remove the financial risk of MEPSC from this 1.8 so that I will be left with asset beta, which measures only business risk. So to do this, what will I do? I will ungear the what? I will ungear the proxy beta. So let's go and ungear the what? The proxy beta. What's it first? 1.8. We have 1.8. So we need to ungear this. Ungear the proxy equity beta. Using what? Which one you use? Using ME gearing. We are using MEPSC what? Gearing. You have to use the gearing of MEPSC. Because it is MEPSC that is having this what? That is having this it is MEPSC that is having this beta. So if you want to ungear it, you need to use MEPSC gearing. You cannot be ungearing MEPSC beta and you are using KPSC beta. No, you have to use the beta, the information of the company that is having the beta. So having said this, let's go and state the formula for ungear. And I told you, I've given you earlier that I said you should not cram this. You can now see the reason why I have to teach you cost of capital before investment appraisal, because it's an extension, okay? It's interwoven. You cannot do investment appraisal without cost of capital knowledge. It's not possible. Of course, you cannot even carry out business valuation without knowing cost of capital. It is not possible, okay? That's the reason why I needed to teach you cost of capital before investment appraisal, so that there will be linked and you understand what I'm trying to do. Now, I can conveniently say what I'm doing here is not new to you because we have done it in the past. So, and that's the reason why I said, don't pile up your notes. Revise it immediately. The moment you start piling up your notes, definitely there will be a problem. There's no way, no two-way about it. There's no two-way about it. If you pile up your notes, there's going to be definitely a problem. It's going to be a problem. So please don't pile up your notes. Don't pile up your notes. Revise immediately. Revise immediately so that we can flow together, so that you can understand what we are doing, so that the exam will not give you an issue. You should be able to pass SFM once without any stress. I can conveniently tell you that. Okay, so we are enjoying the better of equity of MEPSC and using MEGRI. So how do I enjoy? If I want to enjoy, I want to get asset beta. And what is the formula? Asset beta is equal to beta of equity times market value of equity all over market value of equity plus market value of debt, 1 minus tax rate. Okay, 1 minus tax rate. Now, I don't have beta of debt. The second part of the formula is not relevant to me because I don't have beta of debt. So I won't consider that. So this 1 minus tax, 1 minus the tax rate. Okay. So I will say this. What is the market value of equity of MEPSC? I will go to MEPSC. I pick the word market value of equity. Market value of equity. Where do we have that? Market value of equity. Okay. The current market value per share is 3 naira. Is 3 naira. How many shares does MEPSC has? You go there. MEPSC has 500 million naira worth of ordinary shares, and the nominal value per unit is what? Is 1. So if I want to get the number of shares, I will simply divide 500 by the nominal value of 1, and that will give me 500. So to get the market value of equity, I will multiply that 500 by what? By 3. So market value of equity is 500. Let me do it this way so that you can understand what I'm doing. 500 all over 1 times what? Times 3. And of course, that's going to give us 5,300. 1,500, sorry. 1,500. What about debt? What is the market value of debt of MEPSC? I go to the information of MEPSC. What type of debt is MEPSC having? The bank loan is for KPSC. Okay, the bank loan is for KPSC. Why the loan note? Okay, the loan note, where is it? 5% loan note, which is redeemable in 2022, is for MEPSC. And of course, it's loan note, so it is traded. Because it is traded, it must have a market value. And what is the market value? The market value is stated as, look at the market value here. We're told that the market value of MEPSC shares, PSC are quoted at what? The loan note of MEPSC are quoted at 102 per 100. What's the total nominal value of the debt? 368. To get the unit, I will divide 368 by 100. I will get the unit of the debt. I will now multiply that unit by what? Market value per unit. I will get the total market value of the debt of MEPSC. So let's go and put that there. I have 368. 368 all over, and be consistent. 368 all over what? All over 100 as 102. That is the market value of the companies there. So I multiply this. What will I have? 368 divided by 100, that will be 3.68 times 102. That gives me 375.36. 375.36. That is my market value of debt for MEPSC. I haven't gotten this. What is the tax rate? That's the next thing. Tax rate is 20%. Tax rate is 20%. So I cannot go and what? And on J. Beta of equity is equal to beta of asset rather. Beta of asset is equal to beta of equity, which is 1.8, multiplied by market value of equity, which is 1,500, all over market value of equity, 1,500 plus market value of debt, which is 375 0.36 into bracket 1 minus 0.2. Please, can you confirm the market value of debt for me to be sure that we are right? So I will have 1.8. Okay, thank you. Times 1,500 all over 1,500 plus 375.36 into bracket 0.8. This is what we're going to have here. So I have my beta of assets to be equal to 1.8 times 500. 1.8 times 500, sorry, 1.8 times 1,500 will give me 2,700, 2,700 all over 375.36, 375.36 times 0.8 plus 1,500. That's 1,800.29 approximately. 1,800.29. So what will be our beta of asset? Our beta of asset will be 2,700 all over 1,800.29. That is 1.5 approximately. 1.5. Normally it's 1.499. Okay, 1.499. So which is what? Or 1.5, approximately 1.5. Not percent, please. Beta is not measured by percentage. Don't go and put percent there, please. Not percentage. It's absolute figure, 1.5. Okay, if this is my beta of asset, the implication is that the industry, the outboard engine that KPSC want to go into, this is the business risk the company will face in that industry. And of course, KPSC is having debt. KPSC is having bank loan. Therefore, in addition to the business risk of that industry, KPSC is going to face financial risk. Because of this, we need to bring on board the financial risk of KPSC and incorporating this in this asset beta in order to get an equity beta that is meant specifically for that project. And to do this, we reject the beta of asset. Whose information will I use now? I want to reject so that I get the cost of equity, beta of equity of KPSC. So I will reject the beta of asset using KPSC gearing. I will use KPSC gearing. How do I do that? I have beta of equity is equal to beta of asset plus open bracket beta of asset minus beta of debt times market value of debt 1 minus tax rate 1 minus tax rate all over market value of equity. So where's the market value of equity? Our market value of equity, let's go to the question for KPSC. How many units of equity does the company have? The company has 208 million all over 0.5. Isn't it? So that is 208 times 2. 208 times 2. 208 times 2. That is 416. And each of them is valued at 3.5. So I multiply by 3.5. I multiply by 3.5. So I will have 208 all over 0.5 times 3.5. Am I correct? 3.5, right? Yeah, 3.5. So what will I have? I have times 3.5, 1456. I have 1456. I have 1456. That's what I have. What about debt? Market value of debt. What debt is the company having? The company is having bank loan. Bank loan is non-traded. It's a non-traded debt. Because it is non-traded, the market value and the book value will be the same. Don't forget the principle we have been teaching all this while. So 6% bank loan. Anything bank loan is non-traded, and because this is non-traded, you cannot have the market value. So I'm going to assume that the market value is also what? 624 million, the book value. So I have 624. If that is the case, what is the tax rate? The same tax rate for the two companies. So we have 20%. So I now say beta of equity is equal to 1.5 plus 1.5 minus beta of debt is 0 times market value of debt is 624 into bracket 1 minus 0.2 all over 1456. So beta of equity will be equal to 1.5 plus 1.5 times 624 into bracket 0.8 all over 1456. So I have beta of equity is equal to 1.5. So we can evaluate this directly, Nabi. Okay, let's continue. We have a plus. Now I will have 624 times 0.8 divided by 1456, and that gives me 0.34. So I will have 1.5 times 0.34. So beta of equity is equal to 1.5 times 0.34 plus 1.5. That is a 2.01. 2.01. That is the beta of equity that we need to use to evaluate this project. So I haven't gotten my beta of equity. What will I do? I will go and compute my cost of equity. I will go and compute my cost of equity using what? Using CAPM. Cost of equity using CAPM. Cost of equity using CAPM is cost of equity is equal to risk-free rate plus beta of equity into bracket market return minus what? Minus risk-free. Beta of equity minus risk-free. So cost of equity because what is our risk-free rate? What's our risk-free rate? The risk-free rate of return is the risk-free rate of return is what? Is 3%. Now look at what the question gives you. Risk premium. Risk premium. So because it is premium, it means you just use it like that, you don't deduct again. So 3% plus 1.5 into bracket 6%. Cost of equity is equal to, so 1.5 times 6. 1.5 times 6 plus 3.
Beta of equity is 2.01.
Thank you, Gary. 2.01. 2.01 times 6 plus 3. That's what? 15, Abby?
Yes, sir. 15.06.
15.06. 15.06%. That is our what? 2.01. 15.06%. That is a cost of equity. Now we need to get our cost of debt. What's our cost of debt? Cost of debt, which is our KD. Now the debt of KPSC is non-traded, so my cost of debt will simply be equal to what? The interest percentage, Abby. Don't forget that the formula I gave you, percentage interest into bracket 1 minus tax rate. This is the formula I gave you for non-traded debt. Cost of debt will now be equal to What is the coupon on the debt? The coupon on the debt is what? The coupon on the debt is 6%, 6% interest rates. So 6% into bracket 1 minus 0.2. So cost of debt is equal to 6 times 0.8. 6 times 0.8. That's 4.8%. That is our cost of debt. Having gotten the cost of debt, we can now go ahead and compute our what? And compute our WACC. And compute our WACC. So our WACC would be equal to cost of equity times market value of equity all over market value of equity plus market value of debt. I mean, and do this so that you don't confuse you. Plus cost of debt times market value of debt all over market value of equity plus market value of debt. Okay. Plus market value of debt. So having gotten this, we have our WACC to be equal to cost of equity is 15%. 15% times market value of equity 1456. I mean 1456. Am I correct? Let me be sure. Yeah, 1456. 1456.
Correct, sir.
All over 1456 plus 624. Plus 624. So that is first part of the formula. The second part will now be debt plus open bracket cost of debt, which is 4.8%. 4.8% times market value of debt 624 all over 1456 plus 624 close brackets. So our weighted average cost of capital will be equal to, let us multiply 15 times 1456. 15 times 1456 will be 21,840. 21,840 all over 1456 plus 624. That is 2080. 2080. 2080. Okay, 2080. Okay, that's the first part. The second part is 4.8. 4.8 times 4.8 times 624. That gives me 2995.2. 2995.2 all over 2080. Close. So we have our WACC to be equal to 21,840. 21,840 divided by 2080. Divided by 2080. That is a 10.5. 10.5% plus, what about this? 2995.2. 2995.2 divided by 2080. That is a 1.44. 1.44%. So what do we have? Our WACC is equal to 10.5 plus 1.44, 11.94. 11.94%. Or we call it what? We call it 12%. This is the project specific WACC. This is the project specific WACC. Look at it. Any question on this before we continue? Any question on this?
No, sir. From me.
Mrs. Angela, Mrs. Chunwe, any question on this?
No question, sir.
Okay. So let's go to the second part of the requirement. You see that if you know the principle, You will just be flowing without any issue. Please, the principle is what you should focus on, okay? Not the figure we are deriving here. The principle is what you need to know. When you know the principle, you can solve this yourself, okay, without any problem. You can solve it yourself without any problem. So try and lead yourself through the principle. So B, we want to what? Evaluate this project. Evaluation of the project using net present value. Net present value method. We want to use the net present value method. The question did not ask you to compute net present value, but the appropriate method there is net present value. But I will not tell you now. When we get to APV, I will now tell you where you use NPV, where you use APV. The question might not tell you compute NPV. If you just say evaluate the project, you must choose between APV and NPV. And there are some things you need to see in the question that will make you to know that, oh, I'm going to use APV or I'm going to use NPV. So if I explain it now, it might not be too clear. That's why I said, let us get to what? Let us get to, what do you call it? APV. When we start APV, I will explain. You will now relate it, you recollect. You see that the reason why we're using NPV now. So we want to use the net present value criterion. We have 5 years and our tax is paid in, is it in arrears? Let me see.
In the year it's charged.
The same year, okay, the same year. So we should be going to just 5 years. But if you have 5 years and your tax is paid, you'll be going to what? 6 years, because it means the year 5 tax will be paid in year what? In year 6. So let's go. We have how many column? I have my year 0, yeah, blah, 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 blah. Okay. I will have 6. Sorry. Insert table. 1, 2, 3, 4, 5, 6. We're going to have many. We're going to have many columns. No problem. I'll be adding to it as the requirement arises. We have here. Now I start from year 0. Year 0, year 1, year 2, year 3, year 4, year 5. Okay? It's not complete, right? 1, 2, 3, 4, 5. Don't mind me. I didn't include year 0 before. Okay, let me insert one more. Insert to the right. Okay. Year 5. I remove this. Year 5. Informatics to make it a bit nicer. Okay. Give it both. Now this one should be wide enough because that is what will contain all this revenue, blah, 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 blah. Even though we're going to approximate. Okay, but what I'll do is that I will not use 15 that I used earlier so that our table can contain the figure I want to put in there. If you want to write ACCA, if you are planning to write ACCA, it's better to start getting used to how to use system to plan your results. Though, if it is ACCA, you'll be using Excel. But if you need to write, you'll be using a mixture of a Word and Excel. So if you want to solve question that requires Word, you open Word document, you solve. If you want to solve question that involve Excel, you open Excel and what? And solve. So you need to start getting used to it if you plan to write that exam. So the first, okay, shall we operate in, let me operate in 1,000, please. Permit me to operate in thousands. Let me operate in thousands. so that we have a lesser figure. We have 1,000, 1, 2, 3. Okay, let me copy, paste. 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 And paste here. So the first one we're going to have is what? Is revenue. We're going to have our revenue. Let me put it in same units. Okay, let me reduce the font of this so that it can contain the figure you want to. I used 11. Pardon me for that. Okay, it's too small. Let me put it to 11.5. Let's see. Oh, okay. Let's put it at 12. Let's make it 12. I think 12 should be nice, right? 12 should be nice. So the first one, we have our revenue. Revenue is the first one that will come. So we have to go and compute that. You call that work note 1. Please ensure you reference your solution. Reference it to the working note so that when the examiner is marking, it should be able to trace the figure you have gotten in your main table. It should be able to trace it to what? To trace it to the working note. Okay. So let's go down and put our workings there. So I put my working here. Workings. Working note 1. I says what? Revenue. It's revenue. So I have year 1. I'm not bother myself with this. I'm going to copy this one here. Revenue. I copy this down. Let me see. Copy that. Okay. So I want to apply this table to my revenue. I have my units. Okay. I will have my units. My unit sold. You sold. So I'm working in 1,000. I put it in 1,000. My unit is in 1,000. So let's go back to the unit. Let's go back to the units. Where do we have that information? Unit produced and sold. So 15, 40. I'm working in 1,000, so I will just pick 15, 40, 100, 120, and 190. 15, 40, 100. So I have 15. I have 40, 100. Just give me the remaining 3, please. Okay, 120, 190. 15, 40, 100, 120, 190. Okay, I think I made a mistake there. 120, 190, 120. Don't worry, I will remove it. I've seen it. I will remove it from there. Don't worry. Thank you. So this is our revenue. This is our revenue. This one is disturbing me. Let me just put it in one corner here. This is our unit, right? Now, selling price. Selling price. Let's go and pick our selling price. That will give you the selling price. Oh. This will be disturbing me. Okay, let me do this. Let me just put it down. I think it's better if I put it down here. Let's make it 1. Okay. Doesn't want to stay there. Okay, let's continue. I'll just be managing it that way. So, what is our selling price? It is estimated that in the first year, the selling price will be what? 2,000. In the first year, please look at the language. In the first year, the selling price will be 2,000. So the year 1 selling price has already been given to you. In the first year, the selling price will be 2,000 per component. Okay, the variable cost will be 800 per component, and the total direct fixed cost will be 6 million. Thereafter, while the selling price is able to increase by 8%, please, this is not inflation. No. Okay, this is not inflation. This is growth rate. There's a difference between growth rate and inflation. What the question gives you here is growth rate. We are charging 2,000 this year. So next year, we are going to charge 2,000 times 1.08. That has nothing to do with inflation. We are the one that is increasing the price, not as a result of price level increase. Okay? So that is not inflation. I will pick this 2,000, I will start increasing it from year 2 by 8%. So let's see. Oh, God. What do I need to do here? One minute, please. I'm looking at where I can put this so that it will not be disturbing me. Okay, so selling price is what? It will grow by 8%, 8% growth from when? From year 2. 8% growth from year 2. Let me just approve. Okay. From year 2. How do I manage this space? Okay, 8% growth from year 2. So in year 1, it is what? 2,000. Now, what do you notice here? You see that when I was writing my unit, I removed the 1,000, Abby. I just put 15, 40, 100, 120, 180. But when I'm putting my selling price, what did I do? I put the whole figure, right? So you only express one of the two in 1,000, not the two at the same time. If you are expressing this one in 1,000, you should write this one in full. If you are expressing this one in 1,000, this one should be in full. So it's one of them that you express in 1,000 at a time, not the two. Do you understand? So in the second year, I'm going to have 2,000 times 1.08. That's what? 2,160. 2,160. Okay, we have 2,116. 2,160. Now 2,160 times 1.08. I have 2,333. 2,333 times 1.08, we have 2519. 2519 times 1.08, we have 2721. 2721. These are the selling prices. So what will I do? I will now underline and what? And add and multiply. Let me now multiply. Okay. Don't worry. The next one, I'll just be copying this and paste. I want to do the variable cost. I will repeat it again. So revenue, our revenue now, which is in what? In 1,000 naira. Abi? In 1,000 naira. Our revenue in 1,000 naira will now be multiplication. Let us multiply. This one is not even supposed to be there. Let me remove that column. So splitting, we're splitting. Delete cell. Delete entire column. Okay. So 2,000 times 15 will be 30,000, right? This will be 30,000. 30,000. What about this? 40 times 2,160 should be what? 84,600. 86,400 rather. 86,400. What about this? 2,333 times 100. That is 233,300. 233,300. Then 120 times 2519 should be 302, 302, 302, 280. And the last one, 190 times 2721 will be 516,990. 516,990. 516,990. So these are the sales revenue. These are the sales revenue. Let me give them to underline. These are the sales revenue. Okay. So let me delete all this one I don't want. Let me delete them. Delete entire row. Okay. So this is our sales revenue. I simply do what? I will copy this. I go and paste it there in my table. Copy and paste. Paste. I remove the underline. Sorry. So these are the sales revenue. The next one is what? Variable cost. Let's pick our variable cost. Variable cost. That will be worknote 2. Worknote 2 is our variable cost. Worknote 2 is a variable cost. So let's go and pick the information on variable cost. Variable cost is 800. And variable cost will increase by what? 5%. So let's pick that. 800 increasing by 5%. I simply go here. I can just copy this and repeat. Copy. paste. So this is note 2, variable cost. Variable cost. So variable cost, put it here. Variable cost increasing by 5% also from year 2. So 800. Okay. We have to make this one like this. Yeah, so that we properly formatted. On this one, the figures. Okay, so 800, let's get the other ones. 800 times 1.05. 800 times 1.05. 840. This 840. 840 times 1.05. 882 times 1.05 times 1.05. 926 times 1.05. 0.05. 972. These are the variable costs. So we multiply. Let's multiply them. 800 times 15. 800 times 15. That's 12,000. 12,000. Then 840 times 840. 40 times 840 will give us 33,600. 882 times 100. 882. 88,200. 88,200. 926 times 120. 926 times 120 will give us 111, 120, 111, 120. 190 times 972 will give me 184, 184, 680. 184, 680. So that is that. I copy all this, go and paste it in my solution. I'm going to paste it there. Okay. Remove the underline. Then let me make this formatted properly. So that's our variable cost. Now, because these are costs, I need to put them in what? In brackets. I need to put all this in brackets. I need to put all this in brackets. That's one beautiful thing about Excel. If it is Excel, you can do this once. So that's why when you are writing this exam, you are using Excel. Excel is faster. It's not like Word. Excel will give you faster. You use Excel for all your calculations. So fixed cost. Fixed cost. Fixed cost. That one we what? We increase by 5% from year 2. From year 2. 5% from year 2. It will increase by 5% from year 2. So year 1, Year one figure is 6 million, which is 6,000. Right? It's 6,000. Then I format all these things. I think I did. So 6 million is increasing by 5%. It's increasing by 5%. So 6,000 times 1.05 is 6,300. 6,300. 6,300 times 1.05. 6,615. 6,615 times 1.05 is 6,946. 6,946 approximately. 6,946. Please ensure you are doing it along with me so that you'll be sure of our figures. 7,293. 7,293. So all these are costs. So I will put them in brackets. I put them in brackets. I put them in brackets. Put all this in brackets. Okay. These are the variable costs. These are the variable costs. Which other costs do we have? Which other costs do we have? We have training and development costs. Consider that. We have training and development costs, which are expected to be 120% of variable costs in the first year, 40% in the second year, and what? 10% in each of the following 3 years. So 120, 40, then 10, 10, 10, 10 in 3 places. That is our training and development cost. I go down there and what? And do my workload 3. I copy this, come and paste it, and call this workload 3. Workload 3, training and development cost. Training and development cost. Training and development cost. Training and development cost. Now, we already have our variable cost here. So what I will do is I will remove this. Let me even remove everything. I'm going to copy it from up there so that I will know. Let me remove everything here. Let me go and copy my variable cost from up. Let me copy from here. These are my variable costs. I put them here. These are my variable costs. Variable cost. Now, out of this, percentage of training and development, percentage of what? T and D. Percentage of T and D is what? 120% in the first year, 40% in the second year, and what? 10% in the remaining years. 10%, 10%, 10%. So 120% of 120% of 12,000 is what? 1.2 times 12,000 times 12,000. That is 14,400. 14,400. 14,400. 40% of 33,600. 33,600 will be 13,440. 13,440. Now, all the remaining 10% will be 8,820 here, 8,820, and this will be what? 11,112, 11,112, 11,112. Then this will be 18,468. 18,468. These are the training and development costs. So I will copy it. I go up there. I copy this. I go up there. I paste training and development cost. Post it there. Training and development cost. Training and development cost. So I should put this in bracket as well because they are all costs. Because they are all costs. I put them in brackets. Put them in brackets. Put them in brackets. Put them in brackets. Okay. These are the training and development costs for this company. Now, the next one is not what? Next one is, do you have any other costs? Let me go and check. Do you have any other cost that we need in order to determine our profit? No. No any other cost. So at this juncture, we can compute our what? We can compute our operating profit. Our operating profit. So let's get our operating profit. We have a 30,000 minus 12,000 minus 6,000 minus 14,400. That is negative 2,400. 2,400 negative. So 2,400 negative. Year 2, 86,400 minus 33,600 minus 6,300 minus 13,440. That gives us 33,060. 33,060. Then year 3, we have 2,300, 2,300, sorry, 2,300 minus 88,200 minus 6,615 minus 8,820. That gives me 129, 129,665. 129,665. And the next one is 302,280 minus 111,120 minus 6946 minus 11112. 173, 102. 173, 102. So we have 516,990. 516,990 minus 184,680 minus 7293. 7293 minus 18,468. That gives us 306, 549, 549. These are the operating profits. Now, we need to compute our tax, right? Let me insert below. Let me insert more, please. Oh, I see going to have a more row. Insert row below. Insert again. So I have to have more. Okay, this should be enough now. Below. Okay. These are the operating profits. We need to compute our tax. And of course, when you are doing tax computation, don't forget that in all the expenses we put here, Did we recognize anything depreciation? No, we did not recognize anything depreciation. So in place of depreciation, we are going to compute capital allowance. And the effect of capital allowance is that it reduces your operating profit. It reduces your taxable profit. So let me go and put my capital allowance. Capital allowance. Capital allowance is we call that work note what? Work note 3, Abby? Work note 3, yeah. Now let's go and see information on capital allowance. We're told that what is the scrap value of this asset? What is the scrap value? Are we given scrap value?
Oh,
No scrap value, Abby?
I'm saying that capital allowance should be work note 4. Working note 4.
Okay, work note 4. Okay, we'll change that. I want to see whether we have a scrap value for this.
I think it has.
Okay, where do we have it? I'm trying to fish it out.
Yeah, they say it will be sold at the end of year 5.
Yes, but I have. Okay, did they say that? Where is it? Please. I can't find it. You can, that's why I said that when you are solving question, you can see the reason why you need to jot down, Abby. You can see that when I did not put notes, you can see what I'm struggling to what. It means if you want to get the scrap value now, I need to go and start look at the question again from the beginning. You see, but I did mean I've noted it beside the paragraph. I will just scan through my paragraph. I will see whether I have a capital scrap value or not.
They said the machinery will be sold for 160 million at the end of year 5.
Okay, the machine is expected to be sold for 160 million at the end of year 5. Good. Now, I want to point your attention to this. Let me highlight it so that I don't forget. Let me highlight this. In case I want to forget, please come and attention to it. I need to explain something to you there. But before I explain it, let's go and compute our capital allowance. So we are told that capital allowance is what? Note 4, Abby. It's going to be note 4. And we are told it's going to be straight line. And it's what? It's 10%. It's a 10% straight line capital allowance. So note 4. Capital allowance. Capital allowance. Okay. My capital allowance is normally when we say capital allowance is on straight line, I know what you know is what? Cost minus scrap value. I mean, cost minus scrap value over number of years. This is what you know. Abi? If you were to be in the exam now, and the question tells you this question, that this is a straight line capital allowance, I know what you would have done. You would have said you will have removed scrap value from the cost and divided by number of years. Abi? Now, you only do this if you want to compute your capital allowance based on number of years, straight line. But the moment the question gives you a percentage, look at what we have in this question. Capital allowance is what? Is 10%. You are given a percentage. Please take note. You are given a percentage of capital allowance to be what? To be 10. Capital allowance is 10% on a straight line basis. I did mean the question did not give me rate of capital allowance. That is when I would have said cost minus residual value over what? Number of years. Then the moment the question gives you percentage capital allowance, and the question tells you is what is on straight line, please don't go and do cost minus residual value. Just pick this 10% and multiply by what? By the cost of the machine, which is what? 480 million, right? Just pick the 10% and multiply by the 480 million naira. That is your capital allowance. I believe that is okay. So I won't use this approach. because I am already given a percentage capital allowance. I will simply say that my capital allowance is equal to 10%, okay, of what? 10% of 480. You know, we are working in thousand. So let me call it 480,000 instead of 480 million. So because we are working in thousand. Okay. Now this will give me what? This will give me 48,000. If I'm not mistaken, that is 48,000. Now, this machinery will be sold at the end of year 5 of the project, right? At the end of year 5, this machinery will be disposed. If that is the case, I need to compute balancing adjustment. I need to compute balancing adjustment. Let's get our balancing adjustment. Balancing adjustment. Now, balancing adjustment is what? Is the comparison between sales proceeds and tax written down value. What is our tax written down value? Tax written down value. Tax written down value. We have charged capital allowance of 48,000 naira. How many years? 48,000 naira in 5 years. I've charged it for 5 years. Okay, so 48 times 5 is 240 million. 240 million. Now, that's the capital allowance we have charged. Okay. Now, I'm coming. This is what I'm supposed to do. 480 million minus 48,000 times 5. 480 million minus 48,000 times 5. That will be 480 million minus 240,000. So the balance will be what? The balance will be 240,000. Okay, the balance will be 240 million here. I believe you understand that concept. 48,000 times 5 will give us what? 240,000. That is the total capital allowance we have charged. And then take it from the cost of the asset, which is 480,000. We have 240,000 tax written down value. I will compare it with what? With my scrap value or sales proceed. Sales proceed. What is the sales proceed? The sales proceed is 160 million. 160 million. 160 million. So when you compare these two, we have which one is higher? My tax written down value is higher than the sales proceed. It means that I'm selling that asset as a loss. The interpretation of this is that the asset has 240,000 naira capital allowance that I can still enjoy. Okay, the balance of capital allowance that I can still enjoy is 240,000 naira. But now I sold the asset for 160,000, which is below the what? The capital allowance I'm supposed to enjoy. Therefore, the asset is being sold at a loss. And because of that, government is going to give me a relief. That relief is what you call balancing allowance. So I'm going to have balancing allowance on this. I'm going to have balancing allowance. So balancing allowance. The balancing allowance is going to be what? The balancing allowance will be 80,000. My balancing allowance is 80,000. 80,000. That's my balancing allowance. Okay. That's my balancing allowance. So The balancing allowance you have computed here will be added to 48,000 in year 5 because the asset will be sold in year 5. So it is the year in which the asset will be sold that we are going to charge the balancing allowance or balancing charge. In this case, we have balancing allowance. The balancing allowance is going to be what? The balancing allowance for, sorry, the capital allowance for year 5 is going to be the addition of the capital allowance of 48 million and what? And the balancing allowance of 80 million. That will be the total capital allowance for year 5. So 48 plus 80, 48 plus 80 is going to give us 128. Now, there is a situation where I will not compute balancing adjustments. Okay, take note. There is a situation whereby I will not compute balancing adjustment, that I will compute only balancing allowance. Sorry, I will compute only capital allowance. I will not compute balancing adjustment. What is that situation? Okay, this is the situation here. That's why I highlighted this. If you look at this, the question says the machinery is expected to be sold for 160 million at the end of year 5. The question did not mention anything regarding tax. Abi, if that is the case, you will compute balancing adjustment. But I did mean that the question tells me that the machinery is expected to be sold for 160 million naira at the end of year 5. Or let me state it this way. The machinery is expected to be sold for 160 million naira after tax. Very key. The key word here is what? After tax. The machinery is expected to be sold for 160 million after tax. The moment you hear that says proceed to be after tax, please, you are not computing balancing adjustment, because it means the effect of the balancing adjustment has already been taken care of. That is why the sales proceed is stated as after tax. But if the question did not mention anything after tax, then you are going to compute your balancing adjustment. Please, all these are the key things that you need to know in order to be successful. So that is information I needed to pass across. Let us continue. So I will go to my cash flow table. I put my capital allowance, and it's going to be deducted because it's an allowance. 48,000. 48,000. Let me just copy this and paste. Let me just copy this, paste here. 48,000, 48,000, 48,000. But in the last year, it's going to be 128,000. 128,000. That is the sum of the capital allowance for year 5 and the balancing allowance. That's what made it to be what? 128,000. The moment I have this, I will now get my taxable profit. Let me see if I can do this once. Okay, good. It can be done once. Thank you. Thank God. So I get my what? That will give me my taxable profit. So let me go and compute my taxable profit. Taxable profit. Taxable profit. Now let's get our taxable profit. Look at it, 2,400 negative. Another what? 48,000 negative. That's negative what? 5,400 negative. So it's a negative profit for year 1. So year 2 is 33,060. 33,060. 33,060 minus 48,000. Another what? Another negative 14,940. Another negative 14,940. Okay. Let's continue. 129, 665, 129,665 minus 48,000 will now be 81,665. 81,665 positive. The next one is 173,102 minus 48,000. That is 125,102. 125,102. 125,102. And the last one is 306,549 minus 128,000. That is 178,549. These are the profits. These are the taxable profit. Now, I will charge my tax. Tax is at what? Tax is at 20%. Tax at 20%. Now, you cannot pay tax on a loss. This is a loss. A loss of 50,400. You cannot pay tax on it. So you put dash. You can't pay tax there. You put dash. Let me centralize it. You put dash. Now, in the second year, the loss you made in year one is expected to be relieved. Let me go and show you the information here. Even though the information is not there, that is the normal treatment you should give to it. Let me see, where you can say the company makes sufficient profit from other activities. Coming? I'm trying to look for that information. Okay. Can you identify that portion, please, in your note? The company makes for sufficient profit from other activities. Can I see it in your notes? Can you see it? I will platform.
Is your note I'm using, sir?
Okay. What are you seeing?
Is after that the machinery is expected to be sold for 160 at the end of year 5.
Yes, in front of me, I couldn't see it. The company makes sufficient profit from each other activities to take advantage of any tax loss relief available from this project. Consider that. So you have to relieve your what? Your losses. You have to relieve your losses before you start paying tax. Even though if this statement is not there, that is the normal treatment you should give to it. Okay. You just assume that you have assumed that the company makes sufficient profit to be able to enjoy the loss relief. So I will not pay tax here, and the loss I have, that loss of 5,400, I will transfer it to year 2. I'm supposed to relieve it in year 2. Unfortunately, in year 2 again, I'm making another loss. I will not pay tax because I'm making another loss there. Because of this, my loss is now what? It's now 2. Loss of 5,400, 54, loss of 5,400 plus what? Plus 14,940. 14,940. That's 65,340. So give me 1 minute. Let me just put on the lights. Okay, sorry for the interruption. So our loss is now totally what? 5,400 plus 49.40. We have a total loss of 65,340 Nabi. I will now come in the third year. I have a profit, so my profit can now take care of my loss. So from that 81,665, I will deduct 65,340. So 81,665. I will now have profit of what? 16,325. 16,325. I will now charge my what? My 20% tax. So my tax is 3,265 in that year. 3,265. So my tax will start in year 3 because that is where I will have my what? I will make my first profit. So in the other one is normal thing that you know, 125,102 times 0.2. That is a 25,020. We have a 25,020. And the last year, 178,549 times 0.2. That is a 35. That is 35,70. Let me say 35,710. 710. 35,710. 35,710. These are the what? These are the taxes. Now, look at when I was explaining capital allowance, I made mention of the fact that capital allowance is a non-cash item, but you only need to charge it in order to get your tax. The moment you get your tax, all the capital allowance that we deducted there, we need to add them back. We only deducted them in order to get our taxable profit so that we get the actual amount of tax that we'll be paying. The moment you get your tax, that capital allowance must be derecognized. You have to go and add it back because it is a non-cash item. So I come back here, I put add back capital allowance. Okay, we add back capital allowance. So 48,000, you now add it back. So let me copy. Ctrl V. And the last one is what? 128,000. 128,000. Can you see the treatment now? That is the treatment of capital allowance. That is the treatment of capital allowance. When you are done with this, you now see which other cash flow do we need to bring in. We now come and start your what? Our machinery. Our machinery is 480 million. So it's a year zero cash flow. 400 is a negative cash flow anyway. 480 million. 480 million. Let me adjust this. That one is too small for it. One minute, please. Okay, let me just adjust this one little by little. So whether I can give room for this. Okay, no problem. Just do it this way. 480,000. I don't want to reduce this further. Okay, let's just continue that way. Let me adjust this so that that just be okay. I think let's use it this way. This one I can put fixed costs from FRM. from year 2. From year 2. Okay, I think it's better this way. It's better this way. So this is our initial outlay. All others will be dash, dash, dash. Now, look at my assumption here. You see that initial outlay, that machinery of 480 million, the question did not tell me when the company will pay for it. Though we know that it will be required in what? At the beginning of the project, but we don't know whether the company will make payment immediately. In some question, the question will tell you, we are still coming to such a question, that the payment for this machinery will be made in year 1. If that is the case, it's a cash flow. You treat it when the cash will be paid, not when you buy it. We bought it in year 0, but because the client did not give me further information, I'm assuming that we are paying for the machinery the same year that it is bought. So we are paying for it immediately. We are paying for it immediately. That is my assumption here. That is my assumption here. Okay? That's my assumption here. Now, scrap value, which is the sales proceed. Sales proceed. The sales proceed is an inflow. An inflow of what? An inflow of 160,000. That is sales proceed at the end of, what's wrong with this one? Okay, so it's going to be positive because we are receiving money from the sales. So it will be treated as positive and it's going to be sold at the end of the project. The next one you need to sort is what? Is working capital. Is working capital. And what information do we have with respect to working capital? Let's go and see. Initially, KPSC will require working capital for the project of 20% of the sales, of the first year sales. Can you see that? So the first working capital is going to be 20% of the first year sales. Thereafter, every ₦1 increase in sales revenue will require a 10% increase in working capital. So after the 20% initial working capital of year 1, the remaining working capital is going to be based on incremental revenue. So you compute your incremental revenue, you charge 10% on it. That is our working capital. And that will be because you are using incremental revenue. You are using incremental revenue. The cost of capital that will come out is incremental cost of capital because at all times, you need incremental working capital. You need incremental working capital. So the moment you base the computation of your working capital on incremental revenue, the cost of capital, sorry, the working capital is already incremental. So let's go and compute it. 10%, first year is 20% of revenue, and subsequent year is what? 10% of increase in sales revenue. So what do? I will put my working capital as work note what? Work note 5. Yes, work note 5, I'm correct. Work note 5. So let's go up there, let's go down there and put our work note 5. Work note 5. Work note 5 is working capital. Working capital. So we're told it's going to be based on what? On revenue. Let me bring my revenue down. Let me bring this one down so that we use it as the basis for our working capital. Now, this is the, I will remove this. I will remove this first two. I will bring this one up. This is my revenue. I'll cut it. Paste it there. So this is our revenue underlined. Now I'll go and compute my incremental what? Incremental revenue. Incremental revenue. So incremental revenue, here we have 30,000. Let me remove the underline. So 30,000. Here it's going to be Okay, I think I even need the underline. I need it. So after here, from here to here, what is the increase? From from 30,000, revenue increased to what? 86,400. That is an increase of 56,400. And from there, it increased to 233,300. 233,300 minus 86,400. What will it be? 146,900. 146,900. From there, it increased to 302,280. So 302,280 minus 233,300 will give us 68,980. 68,980. From there, it increased to 51,990. So 51,990. 516,990 minus 302,280 will give us what? 214,710. 214,710. So what is the rate? Rate of working capital. Rate of working capital. What is the rate? Rate of working capital. The question has told you that for the first year is 20%. Abi, that one is stated. After that, it should not be what? 10% of incremental revenue. 10% of incremental revenue. So 10%, 10%, 10%. Okay. Let me add another line here. Let me add like 2 above. Sorry, below. Let me add another one. We need like 2 below. So this is our rate. So now compute our working capital. Because all these are already incremental revenue, Abi, they are incremental in the revenue. So the working capital that will come out is already incremental what? Incremental working capital. Incremental working capital. That's already incremental working capital. So 20% of 30,000, that's 6,000, right? 30,000 times 0.2, yes, 6,000. So its working capital is going to be negative. Negative 6,000. Negative 6,000. Here is what? 10% of 56,400 is 5,640. 5,640. 5,640. And here is what? Is 14,690. 14,690. And after that, here will be what? 6,890. 6,898 rather. 6,898. Then there is going to be what? Please. There will be 21,471. 21,471. So these are the working capital. Now, which year will you treat it? You pull it as year do. Working capital is expected to come into the business at the beginning of the year. So the working capital for year 1 will be in year 0, because year 0 is the beginning of year 1. Okay, year 0 is the beginning of year 1. So the year 1 working capital will be treated in year 0. The one for year 2 will be treated in year 1. The one for year 3 will be treated in year 2. The one for year 4 will be treated in year 3. The one for year 5 will be treated in year 4. Okay, so you now ask me, which one now goes to year 5? Abi, which one goes to year 5? Now, it is expected that whatever working capital you have injected in the business, you are going to get it back at the end of the what? At the end of the project. You are getting the working capital back at the end of the project. So what you're going to do is, you will add all these working capital here. You add them together. Whatever it gives you, we treat it as what? As inflow when the project ends. So that's what I'm going to do. So let's copy this and go and post it in our solution. Let's go and post it in our solution. So I will have it from here, post. Now, I will now add everything together. 6,000 plus 5,640 plus 14,690 plus 6,898 plus 21,471. So the total is 54,699. I will now treat it all as inflow here. 54,699. 54,699. Okay, that's 54,699. 54,699. So this will give me my net cash flow. Okay, this will give me my net what? It will give me my net cash flow. Net cash flow. So let's get our net cash flow. Before that, let me add another 2 lines or 2 rows. So net cash flow here will be, year 0 will be 486,000 negative. 486,000 negative. What about year 2? Year 2 is 48,000. 48,000, sorry, from 50,000 minus 50,400 plus 48,000 minus 5,640. That is negative 8,040. Negative 8,040. 8040. 8040. Then the next one is negative 14,940 plus 14,940 plus 48,000 plus 48,000 minus 14,960. Am I correct? 690. 14,690. That gives me 38,250 positive. 38,250 positive. So the next one is 81,665 positive. 81,665 minus 3265. 3265 minus, sorry, plus 48,000 minus 6898. 6898. That gives me 111502. 119502. 119502. The next one is 125. 102 positive minus 25,020 plus 48,000 minus 21,471. And that gives me 126,611. 126,611. And the last one is 178,549 positive minus 35,710 plus 128,000 plus 128,000 plus 160,000 plus 54,699. Let me confirm my figure, please. Okay, that's correct. I will have 485,538. So these are my net cash flows. These are my net cash flows. What next? The next is to bring down my net, my cost of capital. So DCF at 12%. Look at what the question asks you to do. The question says, irrespective of your solution, Look at it. Irrespective of your answer in B, normally, whatever answer we get in A, okay, whatever answer we get in A is what we are supposed to use to discount the cash flow in B. Excuse me. But the question knows that, the examiner knows that you may not be able to get requirement A correctly. And if that is the case, requirement B will also be wrong. That's why they say whatever you get in A, just assume what? A cost of capital of 12%, regardless of your what? Of your solution in A. Do you understand? So that's why we are using the 12% given in the question. So 12% year 0 is 1.000. Year 1, 1.12 raised to power minus 1 is 0.893. 0.893. Year 2 rather. Sorry. Year 2 is 1.12 raised to power minus 2. Is 0.797. 0.797 raised to power minus 3. 0.712 raised to power minus 4. 0.636 raised to power minus 5. 0.567. 0.567. So these are the discount factor that we are going to use to discount the cash flows. Okay, so let's look at what we are going to have. So what is the present value? Present value. So present value for the year 0 is still 486,000 negative. 486,000 negative. For year 2, for year 1 rather, 8040 times 0.893. 0.893. We have 7180. 7180. Also negative, I mean, yeah, negative. 7,180 approximately. Also negative. In year 2, we have 38,250 times 0.797. We have a 30,485. 30,485. In year 3, we have 119,502 times 0.712. We have 85,085. 85085. Then we have 126,611 times 0.636. We have 80,000. 80,525. 80,525. Then here we have 485, 538, 485, 538 times 0.567. 275, 300. 275, 300. So what is our NPV? NPV. What's our NPV? Our NPV is 275, 300, 275, 300 plus 80, 525 plus 85, 085 plus 30, 485 minus 7,180 minus 486,000. We have negative 21,785,000. 21,785,000 negative. So what is our conclusion? Because our NPV is negative, okay, that is the conclusion now. Conclusion is that the NPV of the project is negative 21,000, 785,000. Therefore, the project should be rejected. The project should be rejected. Full stop. So that is the computation of our net present value for this project. So we're going to stop here for today. Tomorrow, by God's grace, I will tell you the assumptions that you need to make. Okay, the assumptions you need to make, I will state them before we go to the next question. Before then, any question before we call it a day on this platform? Question, please. I'm waiting for a question. If there is any. Do we have any question? Hello?
No questions. I'm still copying the notes. I'm still copying the notes.
Okay, you're still copying the notes. Okay.
Yes, sir.
Mrs. Chiwe and Mrs. Angela, any question?
For now, no question.
No question. No.
Okay. Please ensure you
Maybe you go through
practice
tomorrow.
Yeah. Make sure you go through them before the next class, please.
Okay, sir.
Sir, can we get the video before the next class?
Yeah, I will try and send the video tonight.
Okay, sir.
By God's grace. Okay. I will send the video tonight.
Okay, sir.
Are you done copying?
Yes, sir.
Mrs. Chiwe and Mrs. Angela, are you done copying as
Yeah,
well?
I'm fine. Yes.
All right. So I will try and produce a video tonight so that you can watch it before the next class. By God's grace. So we meet tomorrow, 4:30, to continue the lecture. Thank you.
Good night.
And do have a wonderful night
Good night,
rest.
sir.
Thank you, sir.
You're welcome.